What if the next global debt crisis isn't coming from reckless lending, subprime mortgages, or even inflation? What if it's being triggered not by Wall Street, but by geopolitics, a strategic clash between two economic superpowers? In the corridors of power and behind closed boardroom doors, invisible hands are pulling at the strings of global finance. This isn't about oil or even interest rates. It's about supply chains, critical minerals. Credit markets are rattling, governments and companies are sweating, and most people going about their daily lives have no idea what's about to hit them. By the end of this video, you'll understand how a single trade decision, one export restriction, or one tariff announcement can echo across continents and threatening to upend the global financial order. 1. How critical minerals, trade, and debt are intertwined. To fully grasp what's happening now, we need to go back decades to where modern supply chains, global debt, and trade dominance merged into a fragile global web. Many of the products we take for granted, smartphones, electric vehicles, renewable energy gear, advanced electronics, defense systems, depend on a small set of raw materials, rare earths, and other critical minerals. These materials power magnets, semiconductors, batteries, wind turbines, and even military applications. Over the past 20 years, China has built near total dominance over these strategic materials. For rare earths, China processes almost 90% of global output, while mining around 70% of raw materials. At the same time, global supply chains deepened. Multinationals borrowed heavily, using cheap credit to finance long supply chains, expand production capacity, and build factories worldwide. Emerging markets also took on massive debt, expecting stable trade flows and growth. Corporate debt swelled, sovereign debt rose, and the world became highly interconnected. This intricate web of trade and debt was stable as long as minerals flowed, as long as supply chains remained frictionless. But it was inherently fragile because a single disruption could ripple across multiple markets. 2. From free trade to strategic weaponization, for years, tensions simmered beneath the surface. Western nations had known China's dominance in rare earths and other critical minerals, but were slow to act. In April 2025, tensions escalated when China's Commerce Ministry issued sweeping export controls on several critical rare earth elements, including samarium, dysprosium, terbium, and yttrium materials essential for magnets and advanced manufacturing. This wasn't just a trade policy, it was a strategic move, a warning shot. Industries dependent on these materials, EV manufacturers, tech companies, defense contractors, were suddenly facing uncertainty. Access to key components was no longer guaranteed. Many corporations and sovereign borrowers were highly leveraged, assuming low capital costs and stable supply chains. The export controls challenged this assumption, threatening to trigger debt defaults and market instability. 3. Escalation, panic, and market volatility. Initially, the impact was subtle. Companies with existing inventories managed to continue operations. But as supply tightened, pressure mounted. By mid-2025, industries relying on rare earths faced production delays and soaring costs. Automotive and clean energy companies struggled to source magnets and semiconductors. The ripple effect on revenue and profitability was immediate. Tensions escalated further in October 2025, when China added 5 more rare earth elements to export controls and tightened restrictions around technology and processing equipment. In response, the United States, under Donald J. Trump, announced sweeping countermeasures, 100% tariffs on certain Chinese exports. Along with stricter export controls on sensitive technology, this wasn't a routine tariff dispute. It was a structural shift, a realization that trade, supply chains, and debt markets are inseparable and fragile. Credit markets began to wobble. Borrowers with high leverage saw default risk surge. Investors reassessed exposure to global debt markets. Panic quietly began to brew. 4. When trade tactics triggered debt panic, by late 2025, the accumulated pressure reached a breaking point. Supply shock to critical sectors, companies in high-tech manufacturing, defense, automotive, and electronics began to face real disruptions. Shortages of rare earths forced production delays. Component cost inflation soared, especially for magnets, semiconductors, and battery components. In industries with thin margins and high leverage, this created an immediate crisis. Revenue projections fell. Profit forecasts were slashed. For some, servicing debt became nearly impossible. Debt markets repriced risk as supply chain uncertainty grew. Bond investors and lenders demanded higher yields. Credit spreads widened. Debt previously considered safe became risky. Companies relying on leveraged financing found refinancing harder. Some saw downgrades from major credit rating agencies. Others were locked out of capital markets altogether. Emerging market nations with large dollar-denominated debts faced currency depreciation, higher debt servicing costs, and rising default risk. Global debt markets appeared increasingly unstable. Investor panic and market volatility markets reacted violently. Risky assets tumbled. Credit funds faced mass redemptions. Investors scrambled to exit positions. Safe haven assets, gold, government bonds, stable currencies surged in demand. The global market entered a risk-off phase. The real-world impacts manufacturing slowdowns and layoffs. Factories dependent on rare earth components, EVs, electronics, defense systems, slowed or paused production. Orders were delayed or canceled. Layoffs spread across manufacturing hubs. Industrial confidence collapsed. For consumers, this translated into delayed deliveries, higher prices, and uncertainty. Sovereign debt crises and currency volatility countries, heavily reliant on exports to China or on critical materials, saw export revenues shrink. Foreign currency inflows dropped. Dollar-denominated debt became harder to service as local currencies depreciated. Some nations faced looming defaults. Emerging economies dependent on foreign investment suffered capital flight as global investors moved to safety. Financial institutions under strained banks and institutions with exposure to corporate and sovereign debt saw non-performing loans surge. Collateral values fell. Bond funds faced redemptions. Credit default swap premiums rose. The tightening of credit created a feedback loop. Companies downsized, governments cut spending, economies slowed. Loss of confidence in global supply chains, the notion of uninterrupted trade, vanished. Companies realized their operations rested on fragile, concentrated supply chains. Confidence was shattered. Investors moved to safer assets, signaling the end of cheap credit. Why policy responses are coming too late, recognizing the severity of the crisis. Governments and central banks scrambled to respond. But their traditional tools, once powerful, proved insufficient or mistimed in addressing a supply chain-driven geopolitical debt crisis. Emergency liquidity measures and debt restructuring central banks injected liquidity to stabilize cash flows, encouraged corporate debt restructuring, and offered temporary support to sovereign borrowers. However, the scale of these measures was tiny compared to the systemic risk. Liquidity injections could only stabilize short-term cash flows. They couldn't rebuild supply chains, replace rare earth processing capacity, or restore investor confidence in fragile debt markets. Debt restructurings came with strings attached, higher interest rates, tighter covenants, and shorter maturities, which added pressure to already stressed companies and governments. Attempts to diversify supply chains, some multinational corporations began scrambling for alternative suppliers outside China. Governments pledged incentives for domestic mining and processing of critical minerals, and partnerships were explored with Australia, India, and Africa. Yet reality struck. China still controls the majority of global processing capacity and has decades of expertise. Building competitive supply chains elsewhere is a multi-year effort, leaving industries exposed in the short term. Trade deals and temporary truces in June 2025, there was a brief thaw. China shipped additional rare earth magnets to the U.S., temporarily easing supply chain pressures. However, export controls remained, licensing restrictions persisted, and geopolitical trust had been broken. In October 2025, China announced renewed export restrictions, signaling the crisis was far from over. Temporary fixes bought only a short window of calm. The structural fragility of global debt and supply chains remained. History repeating in a new form, echoes of past debt crises. Historically, global debt crises emerged from interest rate shocks, currency devaluations, or fiscal mismanagement. Latin America in the 1980s, Asia in 1997, or the global financial crisis in 2008. What's different now? The shock is geopolitical, targeting supply chains rather than financial instruments alone. Rare earth controls and strategic tariffs have the power to destabilize entire sectors simultaneously. with debt markets as the transmission mechanism. Shocking data points. China processes 90% of global rare earth supply, giving it immense leverage over industries worldwide. April 2025, China restricted exports of at least 7 critical rare earth elements. Market reaction. Over $1.5 trillion in global market value wiped out in just 2 trading days. High-tech and defense industries faced immediate production delays and cost spikes, threatening leveraged firms with default. Global economic implications. The world has entered a new paradigm. Supply chains, debt markets, and trade policy are inseparable. A single strategic move by a major nation can trigger cascading debt crises. Investors must consider geopolitical risk, not just traditional economic metrics, when evaluating global exposure. This crisis shows how fragile the system is. Decades of globalization and reliance on one dominant processing nation have created systemic vulnerabilities that were previously underestimated. Critical mineral control is now a financial lever. Rare earth export restrictions can destabilize global debt, manufacturing, and entire economies. Global debt markets are highly sensitive to geopolitical events. Companies and countries that rely on stable supply chains are vulnerable to strategic moves that disrupt trade flows. Temporary fixes are insufficient. True resilience requires diversification, strategic stockpiling, domestic mining capacity, and a reevaluation of debt leverage in a geopolitically unstable world. The crisis may just be beginning. What we've seen so far may be the first wave. Supply chain disruption triggered by rare earth restrictions is only one front. As nations adjust policies, impose export restrictions, and reorient alliances, new vulnerabilities will emerge. Debt maturities continue to come due. Many corporations and sovereigns have not yet felt the full force of refinancing pressures. Repeated supply chain shocks could lead to chronic instability, recurring recessions, and prolonged inflation. Investors, companies, and governments must prepare for a world where trade, debt, and geopolitics are inseparable. If you found this analysis insightful, hit like and subscribe for more deep dives into the hidden forces shaping global finance, debt, and trade. Share this video with colleagues, investors, or anyone who follows global markets. Knowledge is the first line of defense in a world where the invisible chessboard of global finance and geopolitics is shifting beneath our feet.